Welcome to JM Financial Mutual Fund's Fixed Income Outlook. In this short video, we would take a look at how different global and domestic factors behaved during the month gone by. We will also share our views on the domestic fixed income markets, which could, in turn, impact the positioning of our schemes. 10-year benchmark United States Treasury and benchmark yields of 10-year German Bund softened by 12 basis points and 33 basis points during the month of November 2024, whereas 10-year Japan Bond hardened by 11 basis points during the month. The U.S. economy in November 2024 continued to harden and closed at 4.17%, amid fiscal worries after Donald Trump wins presidential race. The Federal Open Market Committee cut the policy rate by 25 basis points on expected lines to the 4.50% to 4.75% range, retaining data-dependent guidance. The labor market conditions have eased and inflation is trending lower towards the 2% target. While the U.S. economy continues to grow above its trend pace, some slowing in the pace of growth was visible in retail sales and industrial production. Both U.S. Core Consumer Price Index and Core Producer Price Index surprised to the upside. The United States Treasury yield softened across 10-year and 30-year yields, moving down by 12 basis points each, whereas 2-year United States Treasury moved down by only 2 basis points, thus reducing the 2-year versus 10-year spread to 2 basis points. Bank of England reduced its interest rates to 4.75% from 5.0% in the month of November 2024, second time since COVID, and said future reductions were likely to be gradual, as it predicted the British government's first budget would lead to higher inflation and economic growth. 10-year Japanese government bonds have been hardening and closed above 1%, last seen in August 2024, at 1.05% in November 2024. Yen averagely was at 153 levels in the month of November 2024. The Japanese yen could weaken, moving in sync with yield divergence against the U.S. economy. Given the Bank of Japan's plans to normalize policy, scope for sharp depreciation of Japanese yen is limited. The monetary policy divergence of U.S. and Japan will be a key risk for global markets. We remain watchful of the developments, as Japan is one of the largest holders of United States Treasury, and the interplay between US dollar versus Japanese yen, 10-year Japan benchmark and 10-year United States Treasury continues to provide uncertainty on global rates. The 10-year GSEC traded in a band of 6.74% to 6.85% and closed at 6.74% in November 2024, vis-à-vis 6.81% in October 2024. Yields of 91-day T-bill eased by 2 basis points, whereas yields on 182-day T-bill and 364-day T-bill hardened by approximately 2 basis point and approximately 5 basis point respectively. Indian benchmark bond yields were lower by 6 basis points during the month. In tandem with United States Treasury yields, which drifted higher, 10-year Indian government bond were broadly between 6.79% to 6.85% levels during the month. Towards the end of month, 10-year benchmark yield moved to its historical low of 6.74% levels, as growth decelerated substantially in Q2, which could demand an offset by policy impulse by injecting more liquidity, possibly by doing a cash reserve ratio cut, to neutralize tight liquidity witnessed due to currency demand and tax outflows. GDP growth for Q2 FY 2025 stood at a mere 5.4%, substantially lower than 6.7% recorded in Q1 FY 25 and 8.1% in Q2 FY 24. Though some moderation was expected, with high-frequency indicators pointing towards slowdown in both supply and demand-side levers, the reading came in way below the general market consensus of 6.5%. Notably, private consumption expenditure, which accounts for 56% of the GDP basket, grew by 6.0% in Q2 fiscal year 2025, lower than 7.5% in Q1 FY25 but substantially higher than 2.6% in Q2 FY24. Recovery in rural demand could likely have supported the private consumption in Q2 FY25. Growth momentum in gross fixed capital formation has slowed, with incrementally lower growth seen in the last 4 quarters. On the other hand, government consumption expenditure witnessed a decent growth of 4.4%, after observing lackluster degrowth in the past 3 quarters. On the supply side, gross value added grew by 5.6% in Q2 FY25, lower than 6.8% in Q1 fiscal year 2025 and 7.7% in Q2 fiscal year 2024. CPI inflation rose to 6.21% in October 2024 from 5.49% in September 2024. The reading also came in higher than the Bloomberg's median poll of 5.90%. Although there was a favorable base of approximately 65 basis points, the year-on-year reading increased from 5.49% in September 2024 to 6.21% in October 2024, led by a steep sequential increase of 134 basis points. Food and beverages inflation sharply rose to 9.69% in October 2024 from 8.36% in September 2024. Vegetables observed higher inflation of 42.18% in October 2024, an increase from 36.04% in September 2024, led by higher sequential increase. On a sequential basis, vegetable prices increased by 8.15% in October 2024 from 3.53% in September 2024, along with vegetables, cereals and products at 6.94%, 6.84% in September 2024, edible oils at 9.51%, 2.53% in September 2024, fruits at 8.43%, 7.65% in September 2024, noted an increase in inflation. On the other hand, pulses and products inflation moderated to 7.43% in October 2024 from 7.65% in the previous month. In October 2024, the Consumer Price Index ex-food and beverages stood below 4.0% at 3.01% for the 14th consecutive month. Core inflation rose slightly to 3.67% in October 2024 from 3.49% in September 2024. Also, personal care and effects noted a higher inflation of 10.99% in October 2024, compared to 9.00% in September 2024, led by significant increase in gold and silver prices. Donald Trump's win in the presidential elections led to a strong strengthening in the US dollar index. During November 2024, US dollar index appreciated by 1.87% and closed at 106.23. While US dollar appreciated during the month, all the key currencies noted a depreciation, except Japanese yen, which appreciated during the month. US and Japan have been on the opposite sides of the monetary policies keeping the global currency market volatile. In December 2024 policy, the Bank of Japan, BOJ, is expected to deliver another rate hike, thereby keeping the Japanese yen supported. Indian rupee depreciated by 0.72% in November 2024. Indian rupee traded in the range of rupees 84.1 to 84.50 per US dollar during the month and ended the month at rupees 84.50 per US dollar. Foreign portfolio investments were net sellers in both equity and debt markets in November 2024, with outflows of rupees 21,612 crore and rupees 36 crore respectively. Due to excessive pressure on Indian rupee, forex reserves have been on a declining trend. Forex reserves stood at US $656.65 billion as on November 22, 2024, compared to US $684.8 billion a month ago, noting a decline of US $28.2 billion during the month. Liquidity conditions during November 2024 noted momentary tightness following the outflows related to GST. Also, slower government spending and selling pressure from the FPIs could have led to liquidity slipping into deficit. Daily average liquidity surplus moderated to rupees 141,492 crore in November 2024 from a daily average surplus of rupees 150,012 crore in October 2024. The daily average of weighted average call rate stood at 6.52%, marginally higher than the previous month's average of 6.50%. Bank deposit growth stood at 11.2% as on November 15, 2024, same as the deposit growth. On a fiscal year-to-date basis, bank credit has grown by 5.7% compared to a growth of 14.2% in the corresponding period of the previous financial year. On the other hand, on a fiscal year-to-date basis, bank deposits have grown by 6.7% compared to 8.9% in the corresponding period of the previous financial year. Momentum in credit growth has slowed, which is also reflected in the declining credit-deposit ratio. The economic indicators continue to show a mixed picture, especially with strong indicators such as robust GDP and retail spending. The Trump administration to bring regulatory easing. On the other hand, inflation seems to be on a downward trajectory, supporting the Fed's dovish view. Key monitorable remains from developments in China as well as Japan over the medium term. China would be expected to have support both from monetary but more importantly fiscal side to get its house back on track. The resultant impact on commodity cycle upturn may be a development to be watchful of, especially for import-dependent nations like India. Japan, on the other hand, shall be on a rate hike journey, and the resultant impact of unwinding of yen carry trades on various asset classes would be another important monitorable. While domestic inflation is susceptible to volatility due to food components and certain high-frequency indicators in the past few months have shown some signs of moderation, GDP growth printed substantially lower than market consensus. Foreign capital movement away from Indian markets, equity and debt, and to better valued China markets have kept the Indian rupee under pressure. FPIs were net sellers in the domestic debt markets in November 2024 after being heavy buyers since April 2024. Nonetheless, Indian government bonds inclusion in the third global index would help keep the demand-supply dynamics favorable. Also, the new liquidity coverage ratio norms by the RBI would keep the demand side of the equation well supported. Also, the government's intent to be fiscally prudent would act as one of the key positives for the domestic bond market. The government aims to bring down fiscal deficit below 4.6% by fiscal year 2026.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.